Business FM. I'm Lindsay Williams in Cape Town. We're broadcasting from my radio studio at the Artscape Theatre. It's FMR 101.3 FM. This is the cultural centre of the Southern Hemisphere. In the studio, looking back at the week that's almost concluded, the short week, is Victoria Reuvers from Morningstar and also Wilhelm Hertzog from RECM. Victoria, Wilhelm, welcome. Victoria, every time I see you since we spoke at the end of 2015, you say, Lindsay, if you had put that trade in place that we spoke about theoretically in December of last year, you would be making a fortune now. That trade, of course, was buying all the beaten up stocks of 2015, the worst performers, and selling the best performers. I know you haven't got the stats in front of you, but it's been an incredible turnaround, hasn't it?
It really has, Lindsay. And if you look at the divergence in returns in a market where beta has been very scarce, the range of returns is enormous. If we think of the quarter four last year, you had a 93% differential between the best share and the worst share.
Yes.
In quarter one this year, it's over 120% just between the top 60 shares. So, I mean, in a market that's given you about 3. So if you had made that trade, you probably wouldn't be sitting here tonight. You would be sunning yourself on a beach.
I love doing the show, of course, but I definitely wouldn't. I'd be somewhere else. And someone that has put that trade in place to a certain extent is you, Wilhelm, at RECM.
Sure, important to qualify that because we also had that trade on for most of 2015. So
yes.
Unfortunately, we suffered the pain leading up to that. But yes, so far this year, the areas of the market where we've seen value, materials, resources, those have shot the lights out, to be frank.
They really have.
And the darlings of the previous few years in the South African market have gone nowhere to a large extent. So so yes, it's been good for us so far, but it's early days, and there are still various risks associated with those sectors. It's not all a perfectly clear plain sailing ahead necessarily yet. There are still in terms of the underlying businesses, some material risks still floating around. So it's not to say that this will necessarily last, but we still see value.
But it's too meaningful to be a flash in the pan, isn't it?
Difficult to say. Remember, such short-term moves often reverse in the short term. I mean, but yes, it has been material, and I do think it shows almost that for a couple of years one had value defense, not value and defensive, more high-quality defensive stocks being the darlings of the market, and those things have become very expensive, not just in SA, we're talking globally, yeah?
Yes.
Certainly that's been our assessment of the status quo. And stocks which have had a tough time, the cyclicals, have gotten thrashed to such levels that they have just become very cheap relative to long-term intrinsic value. And there seems to have been a bit of a realization that, look, if these companies survive, which increasingly looks like many of them will, at least the larger ones, then there's fantastic value to be had. And there's been this sudden change of sentiment away from what worked last year and the 5 years before that to what has been beaten up over the past 5 years.
The patience you must have had over those few years, you must have been so frustrated, you must have been ready to throw in the towel, and then just, I suppose a lot of people did, and that was why Anglo-American PLC went down to the low 50s, Victoria. This makes your job at Morningstar very interesting because suddenly the managers that haven't been doing so well, as Wilhelm will attest to, have suddenly started doing well. What do you do when you suddenly see an outperformance by these deep value managers? I mean, does it change the way you go about things? It must make you very busy.
We don't change anything we do in the sense that we build portfolios where we always have one manager, so that one manager that's underperforming. So at a total portfolio level, we try to ensure smooth returns. And really what we've seen over the last quarter is all the managers that have been underperforming or we've been defending for the last year or 2 years have really, that performance has turned round and they are the top performers. And the darlings of the last few years are lagging right now. But at a total portfolio level, nothing's materially changed. But just to comment on your point where you said bounce has been so significant. It has, but I think what's been equally significant is the decline that we saw at the end of last year. So to put that into context, a share like Impala Platinum, it's up over 100%, but it's only back to where it was in October, before that massive decline. And when you speak to certain managers, and Wilhelm, I'm sure you will attest to this, is that the volatility in the market now is almost more than it was in the global financial crisis, because at that time everything almost fell in unison. But what you're seeing is these massive moves and so extreme with really no real new news. So there's nothing fundamental that's changed.
Well, a lot's changed since January the 23rd. I mean, January, the VIX index, I can't remember what it was, but I know that about 3-4 days ago, the VIX was at its lowest level of 2016. So the market has become becalmed, and maybe it's because of the number of holidays we've had internationally recently, but something's got to give. And to me, one of the most significant events that I've seen this year has been the Bank of Japan not stimulating a couple of days ago. They said, the market fell, the Nikkei 225 fell 3.6% after they said, we'll leave things unchanged. And what they said was they didn't really understand what negative interest rates had done to the market and to the economy. They couldn't understand the impact. That said to me, they don't know what they're doing as a simplistic broadcaster. But I think it was a really meaningful moment.
Sure, and perhaps it did just remind markets that, look, central banks and the stimulus they've been providing can't last forever and maybe has reached the limits of its effectiveness. And we saw the yen increase quite sharply on that announcement of no further stimulus, because I think there's been a pervasive expectation that central banks will just keep doing what they've done for the past 5, 6, 7 years. But clearly there's a realization that they won't and they can't. And as you say, no one is really sure. I mean, we're living through a financial or a monetary policy experiment, the likes of which no one has really seen before.
It's a long experiment.
It has been, and it's been quite extreme, and no one's quite sure how it will end. But certainly, I think there's a underlying sense of concern that if rates ever start rising, there will be some dramatic impacts, and rising in a sustained fashion, because rates as low as they have been for as long as they have been must invariably distort asset prices somewhere, somehow, and you can bet that someone has invested capital on the basis of those asset prices staying where they are, or at least maintaining value. And if that assumption no longer holds, there could be some panic in the ranks.
Panic. Could there be panic? We've talked about the Bank of Japan. Your comment on Bank of Japan and negative rates, firstly, before we go on to the Fed.
Well, I agree completely with what you were saying. It is an experiment we're living in, and it absolutely makes no sense. The fact that you're prepared to pay central banks to look after your money, for the luxury of looking after your money, and then in 10 years from now you get back less than you gave them, it really is creating perverse behavior. So incentivizing managers to or investors to either invest in, as you say, create asset bubbles, or just seek any form of yield. Yeah. So I think that does increase the risks. And typically when the VIX index is at its lowest is when sometimes the risks are the highest, because they become complacent.
And US Federal Reserve, continuing with you, she did the wrong thing, I think, in December by raising rates. She had to do it. She was forced into a corner, and to maintain the credibility from all the build-up to it was the reason that she did it. In my humble opinion. And now she's saying it's data dependent again. I mean, come on, how many more times are we going to be told it's data dependent if the unemployment rate continues to fall to full employment, which is essentially now, if wages start to rise, which they're not doing, if inflation starts to pick up, then and the GDP growth picks up, then we will raise rates. It's been the same for ages.
Well, you can see that in markets. They're trading sideways. They're looking for some form of something. And I read this tongue twister, which I'll see if I can pronounce, which is the Fed rebound was the Fed's refound dovishness. That was quite good.
Fed rebound is the Fed's refound. Yeah, on a Friday night I won't be able to say that. Luckily this is a pre-recorded.
Really, so the Fed raising rates in December also gave them something to do should they need to actually lower rates going forward. Is 25 basis points material? No.
It's not.
Does it signal the start of something? We are still of the view that this is going to be a very long, gradual rate increase hiking cycle. At the start of it, there's now a 22% chance of a hike in June, but really that they've become data watchers again.
You're not a macro person, are you? But you have to have a look at it.
Sure, and I guess from our point of view, we try to steer clear of having to forecast when rates will rise and that type of thing. We try just to take cognizance of the fact that there are low interest rates priced into many assets, specifically yield-generating assets, and approach those with a necessary caution if one has the view that the rates where they are now probably won't be there forever. So that's probably extent to our explicit factoring in of interest rates in our views when we invest money. We are bottom up investors.
So you don't want to look at that at the macro side of things. It was the 400th anniversary of the death of William Shakespeare a few days ago, and he wrote a play which is completely unbelievably complicated to read, but it was called Much Ado About Nothing, and that's what the central banks did this week. Nothing, but we make so much of it, and I think we're wrong in doing that. And it's the fault of TV stations and radio stations talking about this all the time. It's a lot of nonsense. Wilhelm, you're the one that is the voice of reason here because you're bottom up and you have a look at the valuations. What are the valuations like at the moment? So, Victoria, I'll come to you in a second.
By and large, still much the same as we've seen them last year. So, still a fairly wide dispersion between the safe, high-quality, cash flow generating assets, which have become very popular over the past, say, 3 to 5 years and have become very expensive, and more cyclical stuff. And I'm thinking here about energy, materials, financials, banks and insurers. Just looking at the optics of the numbers, so price-earnings ratios, price-to-book ratios, it's blatantly clear where the value is. When that valuation gap closes, it's difficult to say, and we don't try to forecast that, but that's certainly how we see the lay of the land, is that by and large, the value is still in the cyclical and in the financial sectors, if you want to put it that way.
The oil price is an amazing thing, Victoria. It's gone from $27 a barrel at the end of January, early February, to current level $48 plus. I mean, I'm not very good at maths, but if you divide 21 by 27 multiplied by 100, what is that, about 80% it's gone up in a matter of 2.5-3 months?
Yeah, and there's a wonderful thing in markets called the base effect, which when you see the impact of the fall in oil price, which fell so quickly and so fast to these to the levels a few months ago, when those work their way out of the system and the new oil price kicks in at 45, although 45 is much lower than 70 or where it has been, that base effect of the impact from 38 or 20 odd dollars is going to really come through in the inflationary numbers and the growth numbers. But
not core inflation, just CPI inflation. I mean, if you strip out the food and energy factor, both in South Africa and the United States of America, it's a completely different picture.
Yes, it is. That is true. But what you have seen in the US is that growth is picking up. It's not negative. It's weak. Everyone's looking for much stronger growth, but there is still growth, and you've seen broad wage increases as well across the board. But I want to go back to your point about the fact the numbers we all hang on the data, looking at that data, because the irony is that investment returns are very uncorrelated to economic growth. So we hang on these growth numbers and we're looking for growth and we say money follows the growth, but as a value investor, you're not dependent on that growth. And what we find very interesting when we look at managers and we're putting portfolios together is to look at those managers that they are value investors and they're actually investing the way they should be, as opposed to value investors either chasing very expensive shares.
He's got a big smile on his face with you saying all this.
Yeah, they've held their line. Not easy, but it's come through in the last quarter, and you can see that in the returns. Okay, we'll take a break now. After the break, Business FM will continue, and we'll have a look at that growth and economic data versus market performance. Business FM will be back in a moment. Welcome back to Business FM. Looking back at the week that's almost concluded, with me is Victoria Reuvers from Morningstar and also Wilhelm Hertzog from RECM. What were we talking about before the break? We were talking about the lack of correlation between economic performance, macroeconomic performance, and stock markets, Wilhelm, and you were nodding away furiously. There's a big love-in going on here between you when it came to analysis. It is true, isn't it?
No, sure it is. I mean, there's very little correlation between economic growth in a country and returns from stock markets in those countries. And the reason is simply that investors typically price in any expected future growth, and hence if the future growth eventually arrives, there's no real impact on the stock market because investors have already anticipated that, bid up the assets accordingly, and you don't really see any return from the stock market as a result of the economic growth. And also, returns from companies is much more dependent on the dynamics of capital allocation, competition, and how that impacts on profitability of underlying businesses and the stock market as a whole, than it is on growth as such. You've seen that in China, very rapid growth for a very long period of time, but the stock market hasn't really gone anywhere, and it's because of ferocious competition and massive capital flows into that market, which basically drives down the returns on capital for everyone in the market, and hence investors in companies don't make hay as you would expect in an environment where growth has been so rapid.
Someone told me that the turnover has gone down on the Shanghai Composite Index from 1 trillion yuan per day to 200 billion or something like that. I'm not sure, but I don't think it's representative of what's really going on in China. What is representative of what's going on in China? I don't know. It's too big a country. You were saying something during the break there, Victoria, about an interesting statistic from a company just around the corner from here, Investec. What was it?
Yeah, Investec Asset Management did some work on really what are the drivers of the rand. As South Africans, or man on the street, it's often a barometer of how we feel about our country. But their work showed that about 30-odd% of returns or the movement of the rand comes from the dollar. So we just pulled along by the nose. So euro
dollar being at 114, that's why the rand is at 14.25.
Yes, exactly. So what happens to the dollar? About a third of the return or the movement can be explained by commodity prices and their demand. And so those two, in a way, are slightly linked, but really that's dependent on China and growth. And about 40% comes from South African specific factors. So political risk, growth, inflation, anything that we've done to ourselves. So when you think of the last year, really, we were hurt by commodity prices. We've seen the dollar strength last year, and then we've seen a couple of own goals being scored at home. So there was so much bad news in the price, and with the rand going back to 14, everyone's thinking, well, what's happened domestically? But it's really just a function of dollar weakness at this stage, and a little bit of maybe calming on the political side. But it could easily continue to strengthen, and that would surprise a lot of people.
The rand tends to go in one direction. I always use the example of like a junkyard dog which is on a lead all day, and it's sitting there with one eye open and doesn't do anything for a while, and suddenly it sees something it doesn't like, and it runs and runs and runs and runs and gets yanked back by its chain. But the rand eventually will get yanked back, maybe when it's at 12.50. But it ran and ran and ran and ran from 6.50 in, when was it,
2011.
6.50 to 17.
Yeah.
That was the junkyard dog factor.
It's almost 5 years ago to the day that the rand was at its strongest point against the dollar. But at the end of last year, it really had all the negative possible news in the price. And so if we see rand strength, we just need a couple of things to happen at home, some good news, a bit of dollar weakness, and a little bit of positive growth out of China, a bit of strength in commodity prices, and you could easily see the rand strengthen.
Wilhelm has switched off now because it's a macro thing that you don't... you must plug it into your investment equation, don't you?
No, absolutely. Especially.
What do you say at the moment?
About the rand, we think the rand is still undervalued at this level against the dollar. And if you look at currencies, and if you strip it down to its basics, essentially attractive currencies are currencies which are priced cheaply on a purchasing power parity basis relative to the currencies of the country's trading partners, and currencies which offer you a positive carry, i.e. interest rates higher than that of other countries. So South Africa ticks both those boxes. Historically, sticking to currencies which are cheap on a purchasing power parity basis and which offer positive carry has worked out well in terms of pure currency investing, and that's where the rand is at this stage. And as an aside, we think the dollar is very expensive on a purchasing power parity basis relative to the currencies of its trading partners.
Is it going to break out of the 105, 115 range euro dollar? Come on now, this is a big call.
I don't know about trading ranges, etc., but certainly we expect the dollar to be weaker over time. In the next 5 years, our expectation is the dollar will at some point be weaker than where it is today.
Yeah, there was a chap from HSBC, I think, a South African fellow who's the head of HSBC Forex, and he's a very flamboyant chap. I can't remember his name, but anyway, he about 3 months ago said the dollar is going to weaken, the euro is going to strengthen, and he's been absolutely right. It was about 106, 107 at the time. What do you say?
Oh gosh, calling the currency is definitely, I have no idea.
Okay. We won't hold you to it.
No, I really have no idea. I mean, what we've done is we've just tried to build portfolios to perform under either condition. If you have a strong rand, what happens domestically? Well, that's good for inflation. Bonds will do well, listed property will do well, your SA Inc. shares will do well, assuming you don't get downgraded. But if the rand weakens further, then your offshore component within portfolios will help you. So we've just tried to be as not take any one-way bets in this market. This is about staying as close to diversification as your friend.
Second most important event of this week, apart from the Bank of Japan doing nothing and their reaction to the fact that they did nothing, in other words saying we don't know what we're talking about, was Anglo American PLC coming out with an announcement yesterday about selling its molybdenum. Molybdenum, that's another Friday night thing.
Niobium and phosphate acid.
That's right, exactly right. And it was interesting, not because they got $1.5 billion for it, but who was buying it? The Chinese were buying it, which tells me that the Chinese are now, as clever traders, coming back into the market for commodities. Yes, no?
Yes, potentially. I think there's still capital to be invested out of China. And one had the fear and the concern that China's investing in the commodity space would be very pro-cyclical. It would only happen in the good times in 07, 08, maybe 2011, and we did see a lot of investments in the sector from China at that time frame. But I think it's quite encouraging that they're continuing to invest in the sector at these bottom of cycle type of conditions, because it's a much braver decision to do it now than it was in 07, 08 or 2011, when it seemed easy and growth would continue forever, but the assets were very expensive then. A much better environment.
They're better at trading than commodity companies are as well. I mean, commodity companies tend to buy at the top and sell at the bottom. Is Anglo American selling at the bottom? This is the key point here.
Yes, they are. I mean, there's no doubting that. The question one asks as an investor in Anglo American, and our clients do own shares in Anglo American, is what is priced into the share. And I think this is maybe a good case in point. We're looking at what expectations were for those assets in a sale. The numbers thrown about are sort of $800 to $1 billion, $800 million to $1 billion. They fetched 1.5, which was even above what we thought fair value would be. So I think which also tells you that there are corporate buyers out there, smart, informed investors doing proper due diligence on the ground, not some stock punter shuffling around pieces of paper, putting good money to work at prices far higher than market prices. And interestingly, we've seen that in the copper sector as well, where good copper assets are trading at implied copper prices way higher than spot copper prices on the LME. So there's something there, I think, which tells you that corporate buyers, smart money, values these assets at higher prices than traded markets typically do. We
should have known when people like Glencore cut their zinc production by, I think it was something like 400,000 tons. That doesn't sound like a lot of zinc in the big scheme of things, but somebody pointed out to me that most commodities have long-term fixed contracts, and it's almost like a share that's only got a small free float. If that free float is manipulated a bit by a buyer or a seller, it can really materially move the share price. And if you take 400,000 tons of zinc out of the market, the price goes up because there's no massive free float in this market. Is the commodity sector of the JSE under-owned, according to Morningstar? Or have you not had a look at that yet?
It is under-owned, and if you look at the DNA of the all-share index, it's changed so dramatically that, I think we may have mentioned it before, that there's not one gold company on the top 40. And when you're seeing this rally in the market now, if you've bought a Satrix 40, a top 40 fund, you actually haven't really participated in this rally of all the resource shares, because they're in the mid-cap sector now. So they're under-owned, but they've also shrunk just by sheer function of the price decline that they've experienced. But they've become so hated that it's just become not even a consensus trade, just a given that you're not going to see them.
But on the other hand, with the market being under-owned, according to Victoria and also to other evidence that I have, the fact is that when it does come back, say Anglo American came back to, which I use as an example, came back to R100 a share, there's so much money keen to get in there for the FOMO factor, fear of missing out.
Sure, I think there's probably a valid emotional factor at play.
Yes, indeed. Yeah.
Okay. What is interesting, Lindsay, is the number of fund managers in South Africa that run multi-asset funds who for many years have been very underweight equities. They've been underweight risk assets, and they've been waiting almost with a large cash holding. And there's been criticism of, why have you got so much cash within your funds? And they've actively topped that up. And a lot of the managers that we're actually invested with are almost at their maximum risk asset exposure now, which is quite interesting. Yeah.
Well, it's going to be interesting. Before we get on to shopping, Wilhelm, what do you do now? You can't just throw in the towel. And let's say you get back to a decent level, but you've endured 2 or 3 years of a hellish time as a value investor in commodities. But this is just the start of something that is going to be maybe the start of a new super cycle. Are you patient enough to weather the potential nip back in the market in anticipation of much better returns in the future?
Absolutely. Look, in our investment process, we're driven by price to value and the quality of the assets. As long as the assets are priced attractively in the market, i.e. less than our assessment of intrinsic value, we're happy to own them. And we're not too concerned about short-term pullbacks. I mean, those things you can never time, and you'll never be able to exit Anglo fully at the top and get back in when it pulls back and that type of thing. That's just the type of fancy footwork which we think is very difficult to do consistently. So we're definitely patient enough to sit tight, and the assets are still by and large priced very attractively. Anglo's has had a magnificent run, but it's still priced below our estimate of fair value. So we're happy to be patient and sit tight. And we're not calling the start of a next super cycle by any means, but we see good value and we're happy to sit.
That's
sit
because
tight
maybe you were a little bit too vociferous 2 or 3 years ago when you started buying, and now you've maybe learnt your lesson. Say we do believe it, but we can't say it too publicly. Very quickly. You don't look like a shopper to me, Victoria. You're an outdoor type, horses, etc. You've got a fantastic horse called Dow Jones, who's a champion. So I don't see you as being very much of a indoor type. And Wilhelm, I don't know, you're a snappy dresser and everything, but I don't know if you go and buy these suits yourself. The Mall of Africa opened yesterday. It's the biggest mall in sub-Saharan Africa, probably in the whole continent, and it's got 300 shops, most of which are flagship shops. We've got 1,785 shopping centres in this country, and we are the 5th most retailed up society in the world after the UK, the US, Japan, and I can't remember the other one. But anyway, I think we're 5th, which to me is absolutely staggering, almost bordering on obscene. 1,780.
Sorry, question.
I mean, the retail sector is massive on the JSE, and we do employ 600,000 people in shopping centres, so it's very important. But we've got 9.9 million people that are over-indebted.
We do, Lindsay, and I may not have too much value to add in this comment, other than when it comes to the listed property sector, it is interesting to see how well the sector has done, and it has benefited from this, and there doesn't seem to be too many signs of cracks. And what we've actually seen on a listed property sector, which doesn't answer your Mall of Africa question, is how
just
that
a general
sector,
comment, really.
Yeah, it is how that sector has changed so dramatically, and now 40% of the earnings of our listed property sector come from outside of South Africa. So it's become a much more diverse sector and less dependent on the South African consumer. To answer your Mall of Africa question, I find it astounding. I'm not a mall person at all, so...
It would be lovely to be able to say that thousands of people were standing outside the gates of a new factory that has just been built to produce foreign motor cars, or a new mine had been opened because legislation had been relaxed and foreign investors wanted to come in. Retail sector, property sector, what do you, RECM?
We also find it staggering the amount of retail space per capita that South Africa has, that statistic you mentioned.
Yes.
I do think one needs to take cognizance of the fact that there is a bit of a different culture in South Africa of shopping in a mall as opposed to shopping on a high street, so that does skew the statistics somewhat. So it isn't a direct apples to apples comparison, I think. But yes, we do have phenomenal amounts of retail space, and that scares us to some extent. So our clients don't own any shares in listed property companies at this stage. And I think what's also been interesting is if you look at the makeup of the listed property sector over the past, say, 5 to 10 years, the listings in recent years have increasingly been development companies, and Mall of Africa developer Attack is a case in point, where property used to be the stodgy, boring asset class paying a regular dividend. Now you've got development companies listing, not paying any dividends, promising they're going to plow back capital into developing more retail space. And that's a much riskier proposition than one used to see historically in the listed property sector. So I think that's something which investors need to take cognizance of when investing there.
People have been calling a bubble in the retail sector for a long time, but of course retail sales still growing at a fairly nice clip, 3 to 4%, something like that. We'll have to leave it there. Wilhelm, thank you very much for your time this evening. Victoria, the same. Wilhelm Hertzog is from RECM. Victoria Reuvers from Morningstar. And this show, Business FM, will be back same time next week.